All right, if you've watched any of my other videos, you know that I talk a lot about venture capital, how to get into venture capital, how to start a venture capital fund, all of those things. And today I'm going to cover this really cool concept called AngelList rolling funds. Now, AngelList is this really cool platform. It's been around for a really long time. And essentially it started as this like network of entrepreneurs and companies and investors and kind of like connecting entrepreneurs and investors together. From there, it evolved into this thing where you could put together what they call syndicates. So you'd have like a really great angel investor, and instead of that angel investor putting up all their own money, they could pool money together. And really great, famous angel investors like Jason Calacanis did this and invested in a bunch of great companies, including some really big ones like Calm. Fast forward, AngelList has created this really interesting fund model for venture capitalists called rolling funds. And that's what we're going to talk about today. Because if you're interested in raising a venture capital fund, this could be a really interesting mechanism to get into the game fast and affordable. All right, so quickly, what is an AngelList rolling fund? Well, if you think about a traditional venture fund, the way traditional venture funds work is I, as a general partner or as a venture capitalist, I go out to a bunch of investors and I convince them to make commitments into my fund. And I've got to create a bunch of legal documents. I'll have a private placement memorandum. I'll have a limited partnership agreement that really defines my relationship with my investors. And those investors, they're kind of locked up for this 10-year period. Every time that I need to make investments, I call them up and I say, hey, send me money, right, to make that investment, and then I charge fees on top of that. And these funds usually last about 10 years. You invest for the first 1 to 5 years and then harvest in the second half of the fund and then try and wrap the whole thing up in 10 years. Doing a traditional fund can be really expensive because oftentimes you have to do audits. You have a ton of legal documents. Like I said, those can range anywhere from $50 to $100 to $200,000 worth of legal fees to pull all those legal documents together. You've got to have your accountants and your admin people and your dashboards for your investors and like all of these different things. And so it ultimately becomes pretty expensive. Now, the benefit is you can raise like really big funds. Like there are funds out there that are literally tens of billions of dollars. Go look at funds like Tiger Global is a good example of that. But if you're a first-time fund manager, coming up with an extra $100 to $200 to $300,000 just to get started can be pretty daunting and really keeps a lot of people out of the asset class. And so that's what's really interesting about these rolling funds. A rolling fund, you go to AngelList, you apply, and I'll talk more about that in this video about kind of the criteria and so forth. And what's cool about that is that every new investor that comes in, they commit during a quarter, they sign up for the next quarter. And so they become an investor in all the companies that you invest in the next quarter. And that quarter becomes a little fund in of itself. And now any investments you made, 1 to 5 investments during that quarter, all of your investors have a piece of those deals. And then, they just kind of follow their normal trajectory. The other benefit is you still get paid management fees that help you cover operations. And you still get paid carry on the performance of your investments over time. And the really great thing is that AngelList already has all the documents all put together ready to go. So you save a ton of money, you can get up and running super fast, and you can build over time. And in fact, in some ways, once you get an investor into the fund, assuming that they don't cancel their commitment, you don't have to raise from them again. They just keep going in every quarter after quarter after quarter after quarter, which can be a really helpful way to build your fund because you're not constantly going back and fundraising again and again every 3 to 5 years like most funds. So if the rolling fund sounds interesting, stick around for the rest of this video because I'm going to talk about some of the best practices of how to put this into place and to do it successfully as a rolling fund venture capitalist. So what are some other benefits of doing a rolling fund? Well, if you're an angel investor, you're going out, you're meeting with entrepreneurs already, you're making investments, and the reality is, unless you've got a lot of money, you're probably limited in terms of the amount of capital you can deploy in any one deal, because you don't want to bet the farm, if you will, on these super risky investments. The flip side is, that if you were to write a larger check, you would have more influence within the company, more control, et cetera, and in many ways be able to help more particularly as the company needs more money in the future. And so a rolling fund can be a really interesting way to solve that problem. There are a number of really well-known angel investors that have raised rolling funds because it gives them leverage, right? They're able to leverage other people's money to buy bigger stakes in the company, take board seats, assert more control, whatever it might be. And from the entrepreneur perspective, this is great too, because instead of going to like 50 angel investors and trying to pitch 50 angels, you just go to one and they bring 50 angels with them, but you only have one line on the cap table. So you're not dealing with 50 different angels and all their random requests and advice and chasing all of those cats. In a way, you have this intermediary with this one angel who's kind of managing all of their investors that come behind them. It also, AngelList does a great job of kind of managing all the back office that's related to the company. So they're taking care of the investments and what investments get done and what your portfolio looks like and what the performance looks like for reporting back to your investors. They take care of doing the capital calls for you that occur every quarter and aggregating all the funds and making them available for you. They take care of helping you calculate management fees and carry and all of those different things. And they have the full legal structure in place so that you can operate without having to pay an attorney a ton of money to get up and running. All in all, there are a lot of benefits to doing one of these rolling funds because you can get up and running faster and you can just scale over time, and AngelList makes it really easy to do all of those things. What do you think about these rolling funds? Have you heard about them before? Are they interesting? What questions do you have about them? Throw them down in the comments below. I'm excited to hear what you think. So what's required to do one of these AngelList funds? Maybe you're like super interested, right? All right, so the biggest criteria is twofold. So one, you need to be an accredited investor, which I'm going to talk about in just a second. And the other is you can't be a disqualified individual from the SEC. So basically, if you've gotten in trouble with the SEC, this might not be the best method for you to do this. But that is pretty rare that people get tripped up with the SEC. So that's probably not the big issue. The bigger issue is probably being an accredited investor. Now, if you've watched my other video on accredited investors, you know this, or you can Google search it. But the basic requirement for being an accredited investor is that you're wealthy, that you generate individually $200,000 in income, or with your spouse $300,000, or that you have over $1 million in net assets, not including your personal property. So you can't, say, oh, I live in $1 million house, right? Because real estate's gone through the roof and I'm accredited. Nope, if you live there, it doesn't qualify. So it's got to be other investments outside of that. Well, that disqualifies a lot of really great people that could be venture investing. One of the things that you can do to get around the income and net worth criteria of being an accredited investor is to take the Series 7, Series 65, or Series 82 exams. If you do that, then you're able to demonstrate to investors and the SEC and so forth that you are a knowledgeable person. My recommendation is to take the Series 65 because you don't need a sponsor and it's relatively easy compared to the other two. If you're not accredited, another thing that you can do is go partner with somebody who is accredited. And so they basically have the mantle of being the principal of the rolling fund, but then you're there doing all the legwork and making it happen. And you can kind of do this as a partnership, which can be an interesting way to kind of get around that requirement. Some other things that you should keep in mind that aren't really requirements, but in my opinion are in order to be successful, is you really want to have a network of people that you can fundraise from. All of these people have to be accredited investors in order to participate in your rolling fund. But you can be really flexible on the amount of money that they end up investing in your fund. And like I said, the threshold for being accredited is about $200,000 in annual income. So there are a lot of people that work in technology, for example, a lot of successful business owners, dentists, doctors, etc., that make well over $200,000 a year, would love to play in the venture space and make investments. But frankly, they don't have the time, they don't have the know-how, they don't have the access to deals, they don't have any of those things. And so that's where you can provide kind of a unique advantage where you're doing the diligence, you're sourcing the deals, all of those kinds of things, and you're helping them get access to this asset class. So having some sort of network you can tap into to raise capital is super important and something you should be thinking about if you want to go down this pathway. But that's the same problem you're going to have regardless if you're raising a full-on venture capital fund with an LPGP structure like we've talked in other videos, or whether you're doing this rolling fund. In fact, I think the rolling fund is even more interesting because what it allows you to do is as an individual investor in the fund is you can kind of budget. You can say, okay, I want to put in 50K, and 50K means that every quarter I'm going to pay out $12,500 into this fund, and I can just kind of budget for that. And that's kind of nice. Whereas other funds, they kind of give guidelines, but they're going to call capital anytime they make an investment. So that could mean that one quarter you get a capital call for like $20,000, and the next quarter you don't get any capital call at all, and that makes it just harder to budget. All right, so if you want to do this, the process is fairly straightforward. Just go to angellist.com, go to the rolling fund page, and there's a button where you can apply. You go through the questionnaire and then decide whether or not it's right for you. The next step is, after you've gone through that and gotten it set up, is to go pitch investors. And so this is my number one tip if you want to go ahead and do this. I would recommend picking a niche that you feel like you could be a really good investor in. It could be crypto, it could be healthcare, it could be travel, it could be consumer products, it could be, one of many different things. That's part one. You got to be able to create your thesis on the type of investing you're going to do. Then what you want to do is you also want to identify your market of potential investors and something unique about them that ties in with your investment strategy. So for example, maybe you're like, hey, I think there's a really interesting opportunity to invest in healthcare related startups, right? And then what I'm gonna do is I've got this network of relationships I've built over the years with a bunch of doctors and nurses, nurse practitioners, and so on and so forth, people that meet that accredited investor level, and then go pitch them. That is gonna be the hardest piece of what you do. But what can happen is it snowballs over time, right? You get a couple doctors in, they're excited, they put in, $50K a year to back you, and then they tell their buddies about it, and that goes, and they get excited, and the investments start performing, and so new doctors come in and they put in money, and then, word of mouth gets out, and it just kind of builds and snowballs. And by the way, what's interesting is, even if a doctor or an accredited investor commits, $50,000 to your fund, that $50,000, if you really think about it, is the equivalent of roughly, somewhere between $200,000 and $250,000 commitment to a normal fund, which is pretty big. And I'll tell you, having fundraised for a traditional LPGP fund, when you go and meet with investors and you're pitching them, the idea of putting up $250,000 or $500,000 or $1 million into this 10-year fund can seem pretty daunting, because in their mind they're thinking, oh, I gotta set aside $1 million day one for this fund. Whereas with a rolling fund, they just think, oh, I just need to put aside $100,000 a year, or $200,000 a year, and that will cover me. When viewed in that perspective, it's like, oh, I'm only putting aside $200,000 instead of a full $1 million. Anyways, if you enjoyed this video, check out some of my other videos. Maybe you're not ready to start your own fund, but check out my video where I talk about how to prepare for a venture capital interview, assuming you want to get a job working as a venture capitalist. Thanks for joining.